Hi, this is Steve Davis with Total Wealth Academy, and this is Investor Tip Tuesday. Most people know more about the next pair of jeans they're going to buy, or the next car they're going to buy, or the next house they're going to buy, than they know about their next investment. That is a sign of a very low financial IQ. So what I'm going to do is, every once in a while, the Investor Tip Tuesday will be on improving your financial IQ. Today's discussion is going to be about how commercial property is evaluated or valued. This is based off of a thing called net operating income. And there's a magic formula. At a 6% cap rate, for every $1 that you improve your NOI, it increases the value of your property by $17. So do a quick test on yourself. If you raise the NOI by $100,000 a year, what have you done to the value of your property? You just increased the value of your property by $1.7 million in 12 months. Let's look at a little 30 unit. This is, all the numbers have been rounded off, but this was an actual deal. The picture is different as well. How is commercial property valued? It is based off of net operating income. Unlike single family that's based off of comparable sales, meaning if you've got a $250,000 house in a neighborhood where every other house just like it has sold for $250,000, you got a $250,000 house. When it comes to commercial property, strip shopping centers, self-storage, apartment complexes, you can have two of them identical, built the same year, same number of units, same square footage. One of them can be worth 20 million, one of them can be worth 10 million. What's the difference? Management, how it's run, because that results in your net operating income. One is well run, one is poorly run. In this particular case, this property was poorly run. To determine the value, you take your NOI and divide it by your capitalization rate. We're going to a bank to try and get a loan on this property. They're going to determine what capitalization rate they're going to use. In this case, we have $160,000 a year in NOI. The capitalization rate is going to be 8. You can see there, 160 divided by 0.08 gives you the value of that property, $2 million. And if you look above, our all-in price, purchase price, rehab, and closing cost is $2 million. So it works. The bank is going to give us the loan for that. We'll need about $600,000 out of pocket to do the deal, and we'll have debt of about $1.4 million. But what are the action steps? It's going to be to solve all of the mismanagement that was going on before we bought it. If you look at this deal was 30% vacant, horrible. It shouldn't be more than 5, maybe 8% vacant. The rents were $50 to $100 per unit below market, and they didn't have a laundromat. They didn't charge for parking. They didn't know what they were doing. And this is very common in this industry. But that's why the property was only worth $2 million. But watch what we do. We're going to rehab the entire exterior. We're going to rehab all 30 interiors. We're going to raise the rents to market. We're going to fill all the vacant units and add a laundromat. What does that do to your NOI, net operating income? It increases it. 18 months later, we had a new NOI and a new value. Our new NOI was $240,000 per year. Now look at the cap rate. The cap rate has been reduced. The reason is, when we first bought it, the bank considered it a high-risk deal, 8%. But now that we've rehabbed it, got it occupied, and it's managed properly, it's a low-risk deal, so they lowered the cap rate. So when you take $240,000 and divide it by 0.06, the new value of the property 18 months later is $4 million. You and your family, $2 million in 18 months. I want you to think about this. Do you realize that most people work 40, 50 hours a week for 40 years and don't have $2 million? Raise your financial IQ. Begin to understand net operating income, and you're going to want some of your money there. Thanks for watching.